Okay, Mark. So what a great time to have you here.
Yeah, thanks very much. Can you guys hear me okay? So
yeah.
Welcome to a new era of volatility. Volatility is certainly back.
Yeah, I wanted to ask you, previous two interviews, your cycles were pointing towards trouble in the spring. So we didn't quite make it to spring. We're only a few weeks away from the equinox. We're attempting a rally here. Could it be that the cycles you were looking at that we put in a secondary top? And do you think that this bounce has run its course, or there's more left in it in S&Ps?
Yeah, I mean, there are a number of different cycles. One of them was related to a Saros cycle that actually hit the day before 9/11, which was triggered back on the 19th of February. And so for those that have an interest, I'm happy to speak about that at a later time. I won't take up too much of your time discussing that, but it is pretty
You
important.
also have some stuff coming up in the spring. Wasn't that what you were talking about?
Yeah, I think as we enter April, it's going to be a little bit more interesting. So I think this is what we call the shot across the bow. You know, we've had our initial sell-off. I'm not, all that bearish right now. I think that, for the time being, we put in at least a decent trading low that I think probably can carry a little bit higher. My targets are up, around 3180 to 90 or so on the S&P. So
61.8 back there, Mark.
Yeah, there's a lot of things right up there that are important. So for me, we saw a pretty rapid reversal of some of the things that were a concern last month. At that time, we had pretty rampant weekly overbought conditions. Now we have, at least daily oversold. We had a lot of optimism back then. Now we have pessimism. And a lot of the reasons why the market declined were due to just a lot of the overconcentration of many stocks. Within the S&P, we have the $5 trillion stocks that are, now 19%. So there's a lot of overconcentration, and you look at what was really carrying the market higher.
Right.
And
do you believe, like me, Mark, that this was going to happen anyway, and that the coronavirus is just an excuse and lit the fuse, but that we had
that's right. It's
some
a
market
catalyst.
structure.
I mean, the market certainly isn't selling off, specifically because of that. I think a lot of the stuff started to turn down in the middle part of February, and should be actually negative for the year as a whole, if I'm right. After a number of years of being bullish, I actually went negative for the year in January and said this was going to be a down year. And historically, when you look back, there's only been 11 times when both January and February have been negative, and the year has been negative every time. So I'm not convinced yet that we've seen sufficient damage to say it's going to be straight down. I think it very much could be a choppy year, but if my thinking is right, I think we do get the weakness from April into July, August, and then rallying into year end should make us want to sell into that, and that next year would really be a very negative year. So this year could be flat to maybe slightly down, but I do see what happened likely has turned a lot of the momentum down pretty substantially. And I'm trying to be very tactical and not swing for the fences. My trading time frame is very short term these days. So
so that's another way to manage risk, isn't it? To not only reduce leverage but reduce TFs, time frames, and
you have to not only be extremely diversified, but keep size very small and have a lot shorter time frame, and just keep cash on the sidelines for opportunities. I think there'll be opportunities for longs and shorts this year. So, today's movement, in the last couple of days, just to put things into perspective, I mean, the volume yesterday was pretty much the lowest we've seen in over a week. Technology really didn't participate all that well. Today's weakness thus far is only given back about 50% of the prior move. So it's not all that damaging technically yet. If S&P were to get down under 2976, yesterday's lows, it seems like we're down over 2%, and we're not even near yesterday's lows, which is amazing. It tells us how volatile things have been. If that happens, then of course I would say, okay, we're likely going to test, if not take out the lows.
You have to be very nimble. Very nimble nowadays.
You certainly do.
Mark, last time we were together, I had a negative view and bias on the banking shares because of what I saw was going to happen to yields, and you and I agreed that we were going to see sharply lower yields, that yields had not troughed yet, and the XLF never made new highs while the S&P were marching to new highs. So I'm thinking, I don't know what your look is, but I'm looking for about 150 in the 30-year yield. And I think that we're very close to putting in at least a trough in rates, not the bond top, but enough for a bond rally. And perhaps that could get the banking shares back into the game for at least a good bear market rally. So what are we looking at?
I don't
30-year
disagree.
bond?
So let's start with XLF first. So
Okay.
XLF was right near the highs from, 2007. We never really did get above there. It was a pretty prominent peak. Financials were the third best performing sector last year. Everybody's, and now we're seeing mean reversion, but that started largely with what we saw with, the banks. I mean, so the banks, certainly a different animal. And this is all about know what you own. XLF, of course, with Wells Fargo, Berkshire, JP Morgan representing a large amount, but the banking shares certainly have not been doing all that well for some time.
Yeah,
They peaked
they
out
went
last
all the way
December,
back.
and we had a very rapid pullback. And so, we obviously, as rates started to turn down, banks literally right when rates peaked started to also accelerate. And now we're seeing a little bit of exhaustion here in the KBE, meaning that I think that we're close to a chance when these can bottom and at least start to rally off that low. Okay. I would agree with regards to, and I've heard a lot of people say that, which concerns me, but everybody's trying to put in a low in yields. I don't disagree, I guess, from a short-term time frame. I think that is possible, but we certainly have done quite a bit of damage with regards to, on a weekly basis and a monthly basis, getting down under lows from both 16 and 2012. So,
yeah, I'm thinking more of the long end, Mark, and the possibility of, even with yields falling, it looks like we're really not inverting during this decline, because bonds have been a little bit more, the 30 years has been a little bit more reluctant, but I see a 3 drive pattern developing there. Part of the damage was we finally got a pretty good break in the Dixie along with risk. Does this dollar break look like a real turn to you? And I think a takeaway this week was when risk was back on this week, the dollar couldn't find a bid. Where are you at on the dollar here?
Yeah, I think the damage has been pretty substantial in recent days. We'll see how it would need to obviously get down quite a bit further to say that a larger top is in for me. But I mean, a lot of the cycles do point down for this year and over the next couple of years. So, monthly chart. Let's see. We can look at the DXY if you'd like. I mean, that is largely against the euro. This is a little bit more balanced. Near term, I think the dollar peaks out in about bottoms on a short-term basis, probably in the next week. Euro is up against pretty good levels. There's signs now of exhaustion in the DXY. So, I don't know. I certainly wouldn't, press euro longs or anything. I think the move is, we've seen the first move down, and we'll see what type of balance we have on that. I think we're closer to a trading low in this. If we take out January lows, you can make a larger case that, the dollar is going to start to really implode and that we're going to see euro and sterling.
So perhaps some type of fib retrace back to 98 to 99 might be a good area.
Yeah, that's right.
There.
So I see probably, I don't even know that we're going to get too much lower than 96.5. I think in the next 3 to 5 days, we should try to bottom out in that. The BBDXY is not quite there on the exhaustion. So euro is there now. I think that the other currencies might see a little bit more, even here, you look at Bollinger's, and we shouldn't go down too much more in the dollar in the short run. So from a trading perspective, I would play for a bounce, but yeah, from an intermediate term perspective, it's clearly a concern of what we've seen. And if we see much larger breakdowns of January lows, and you can certainly say that the intermediate term trend has started to shift from being really more neutral over the last couple of years to a lot more bearish.
That would be a massive distribution top if we break down,
Right.
wouldn't it?
Yeah.
I mean,
No,
it's
certainly.
huge distribution. So,
But I agree with you with regards to yields trying to bottom out in the next couple of weeks, and so we'll see what shape that comes in terms of how that shakes out.
okay, so the flip side of a weak dollar, and gold didn't need a weak dollar to do what it did. So gold has really been strong, and silver has been really showing a lot of relative weakness. Didn't even make a new high on the last high in gold. Where are you at on gold? A new high coming, and aren't we getting kind of late in the game for people to start turning real bullish gold, even if we trade 1700?
I agree with that. I agree with that only because of wave structure. I mean, I think that many people have remarked that it looks like a pretty clear 5-wave move now to the upside from 2018. Positioning is certainly very, very bullish. It seems like everybody in the world is long the metals and thinks now the economy is weakening and it's right to be in the metals. And I,
except the commercials.
Yeah, I think that we're seeing now some signs that this looks only like a 3-wave move. So yeah, maybe you can make a brief new high in gold, but I do think it's late in the game, and one would want to really sell into that. And specifically for the reasons of sentiment being too optimistic and the positioning too high, along with the fact that silver and gold stocks really have not followed suit on the metals. And so that usually is a warning sign that that's very late in the game.
Any view on energy, on the energy sector? Do you think any signs that we're starting to get close to some type of low or base building beginning in oil-related issues?
Yeah, it's tough to say that with regards to crude specifically. The charts there still look very, very negative. It's we'll see. I mean, we'll see if this is at least structurally, you'd really need to get up over, close to $50 before you think the WTI can start to move up. And the energy sector itself is already down over 25% in 2 months. I mean, it's been a real washout. And so, if you look at it, I actually got long some Exxon the other day only for a trade, and thinking that these have started to stabilize in the short run and can make a little bit of a bounce in the days ahead. So I see it as a good risk reward to play it for a trade, but really anything longer, I just, I don't really see it. I look at this chart. Here's a monthly chart of the XLE and how that looks, and that's just really awful, So on any bounce above, really to the mid 50s, I would certainly look to lighten up in terms of XLE, and we'll see. It needs to do a lot to really recoup some of the damage that's been done. It's been catastrophic. So if the demand slows down materially based on the corona, and I actually have I have a couple contacts that suggest that the things are going to get a lot worse, that the numbers have been very much understated, particularly all along the West Coast, and that it's just a matter of time. And so it's we'll see. Not to scare anybody, but it's certainly not something that's just going to go away right away, even though it might be mild in terms of how to treat it and prevent it, and it's not really a true threat, but it's certainly on its way.
Not this time around. Let me ask you this, Mark, since you brought it up. In the pandemic, Spanish flu wasn't the first wave that was really catastrophic. The first flu season, it was when it returned the second time. Are your sources saying that this is just going to become part of, kind of a virus life cycle, and it can be around for a few years?
I don't know about that. I don't have that kind of information or data.
Okay.
I just know that the next 4 to 6 weeks, which lines up with a lot of cycles, that things are going to get a lot worse. And if people are canceling trips now because of what they think, I mean, in the next month, it's going to be really center stage. And so, for me, that lines up with a lot of things that suggest that, equities at really any bounce you really want to be probably selling into for now.
Okay.
And think that, whether it was a first, 5-wave move to the downside, now we're getting a wave 2 or wave B, that we should have at least a C, or the start of wave 3 to the downside now, that could last between April and July, August. So,
Okay. Yeah.
there's an 18-year cycle. It's actually 18.6 for those that are familiar with that. So,
What's the
we
name of it?
have, so if you look, what happened, SARS was this time 18.6 years ago. And before that
Okay.
was AIDS and HIV, the HIV and AIDS was prior to that. So we have a pretty, my colleague and friend, Andy Pancioli, who's a cycles
Oh,
expert.
I know who
uh,
he is. Yeah.
Yeah, so he's a good guy. He's written pretty extensively about it, and so he turned me on to that, and also the fact that there's also a 100-year cycle also
Yeah.
that's related to a lot of this. So
That was
2018,
the Spanish flu.
yep, 1918, 1818, 1718, 1618, all along the years. So there's
Yeah.
a lot
Ask
of really,
Andy that if the first wave of the Spanish flu wasn't as bad as the second
right.
season.
Yep.
So, Mark, I mean, are you doing anything personally, you and your family, storing up food? Do you think we're going to have some type of medical lockdown in different areas?
No,
I know I'm.
I'm not. Well, I don't. You know what? I mean, I think the best you can do is just stock up on some extra bottles of NyQuil and DayQuil. I think that that's probably the best for lung type issues. But
How about
no,
supply chain issues?
Yeah.
Where there might be shortages of things. Do you think that could happen?
The one thing that I've learned that I think I can pass on is that hand sanitizer is probably one of the worst things that you can put on, because it literally eats away your hands, and it will actually expose you to the virus
More.
quicker than
Yeah.
if you just use
Soap.
some type of the wet wipes, or the things that are hand sanitizer. The actual wipes that you can use are much more effective than hand sanitizer. And so the masks also, as we've heard,
Yeah.
aren't really all that effective, and actually can be eroded within 4 or 5 hours of breathing into them. And so it's really useless to wear something of that sort unless you're going to change it very often. It's more
Well,
about us not touching our own faces, as we know, and trying not to shake hands, and just giving fist bumps and elbow bumps and things of that sort. So,
okay. Well, let me give you an internet hug for coming on and
yep.
clarifying a lot of things for the community and edifying face for us, Mark, like you do so many times. And hope you and your family are safe, and that we catch this failing rally the right day, the right hour, the right 15-minute time frame to ride it
Yeah,
down.
I'm looking at early next week, actually, right around the 8th. The 8th will be on a weekend, so 9th and 10th into the Fed is being important, and then on the 20th, 21st in the equinox, there's a lot
Yeah.
going on there, and then of course in early April also. So
Yeah.
we're certainly entering a time which could be high volatility. The momentum on a weekly basis clearly has broken down, and we saw a couple of years ago when markets peaked in January 18, the momentum reached its highest levels that we'd seen in some time, and then the market went higher and higher. Momentum just really failed to keep up, and that was
Yeah.
really the warning sign. And so, now on a weekly basis, with this having rolled over, I'm expecting that we do at some point get down and test this area near, 2,500, 2,600 area, which is going to be, pretty important. And
Some wave guys are looking for us to go to test wave 4. Where's that? Around 2,400. That's at low in what, 2018? There, is that it?
Yeah, 2346.
Yeah.
Yeah.
Okay.
We'll see how it shakes out. The one thing I would say is, although I do like using logarithmic charts, if you use an arithmetic, just pinpointing the bottom of '09, you've actually hit this on 3 separate occasions right to the nose. So, that's going to hit right down near 2,500 on a pullback. So I do think that does have some importance. The final thing I'll leave you with is that it's always important to watch the 10-month moving average when markets close under that. Historically, when markets break trends and turn down, if you would have been out of the market when we closed under the 10-month, you would have literally been out of the market during the whole bear markets of 2000 and 2003, as well as '07 to '09. So we're actually back up above it right now, but if we close down under that again, say that again.
Where's it coming in? Around 3054?
Yes, that's right.
Okay.
So just say if we fail and pull back under new lows, then you really want to be out of the market, and just wait until that shakes out a little bit. But yeah, right now I think there is a lot of fear, and so that's the one arrow in the quiver for the bulls, and we have gotten pretty washed out and oversold near term. So, you need to consolidate the oversold conditions, which has been happening in the last week. And so, if we rally into the next couple of weeks, I would look to sell into that. We'll just leave it there.
Okay, well, with the calmest demeanor, you're a watchman talking about something that a lot of people probably aren't aware of, the ostriches with their head in the sand. And really, thank you, Mark. Thank you for
my
being
pleasure.
here today.
Thanks for having me on, Dale. It's great to talk to everybody.
If you want to just show your website, Mark, because I think everyone should use you as a resource for what's going on, because you put it all together. The fundies, the technicals, the cycles. You really have a great holistic view of.
Yeah, so I came from the CBOE. I used to trade as a market maker on the floor. I worked as a technical analyst at Morgan Stanley for a few years back in the early 2004 to 2007, and I joined Diamondback, a hedge fund. A lot of ex-SAC guys started out, and then I actually ran my own. I started my own website 3 years ago to offer technical analysis to institutions and to individuals. So feel free to come and visit. I am going to be on CNBC actually today at around 2:20 to 2:25, and potentially fast money if that's
cool.
tentative at this point. But yeah, I am going to be on later. So send me an email to info@newtonadvisor.com. I'm happy to put you on a trial or show you some copies and samples of my work or what I've been putting out, and we'll take it from there.
All right. Well, good hunting, my trading warrior brother.
Thanks, Dale. Take care.
All right,
we'll talk to everybody soon.
All right. Thanks, everyone. That's Mark Newton, and you can follow him on Twitter at Mark Newton CMT, and go to his website and stay in touch with a guy who's a great technician and has a very good feel for cycles and everything that you need to be alert to what's happening in the market. So that's a wrap. Thanks again, Mark. Everyone, remember, don't just count your pips, count your blessings. Stay safe and healthy, and we'll see everyone tomorrow for the NFP. Be here live for it. Adios.